I welcome to you all investors and happy learners who are always curious to know something new. And in this video, we are going to learn about two interesting factors, two terms which is used in value investing and stock market. One term is pure play and the second term is floating stocks. A very good evening to you all. My name is Shubham Best and I welcome you all once again back to this amazing platform of YouTube named as Happiness Prime. This Stock 12 Prime video where we are going to completely focus on these two terms, that is pure plays and floating stocks, starting with the first term. And I hope that you are having a wonderful blessed life and you are having an amazing journey, a happy blissful journey. And let's start with the first term, that is pure play. Pure play is a term which is used for all of those companies which deals in one product line, in a same industry. In one industry they deal in only one type of product, the manufacturing and production and selling of only one type of product line. All those companies are known as pure plays. Now, what are the benefit of pure plays versus diversified companies? What are diversified companies? If I just ask you this thing, you already know because of the term diversified. The companies which are focusing towards multiple types of products for the revenue stream, for the sources of income, for every single thing, they are depending on multiple types of products in different industries are known as diversified companies. And all of those companies which deals in only one type of products for their revenue, for their cash flow, for everything is known as pure play companies. One good example of pure play is Dunkin Brands Group, which is a combination of Dunkin Donuts Coffee House and Starbucks. So that is we are going to discuss pure play. What are the benefits and what are the disadvantages of pure plays, and why, instead of the disadvantages, why does people invest in pure plays companies? First of all, what are the disadvantages? Pure play companies, pure play, the company which only depends on one product in one industry. So overall, in global market, when that particular industry is down, when the industry goes down, the value of the share goes highly down because it is totally dependent on this market, on that particular industry. And that if that industry grows, then the value of the stock just increases. Secondly, it is highly volatile. It is a highly volatile since just one product line. So if that product is going to be in a good state in future, in near future, if that industry is showing, may show good growth, then it is having a nice future. But still in the economic pressures, but still in those conditions where companies are not able to survive, then this stock is one of the most risky stocks ever. So pure play companies, one of the highest factor of risk as compared to diversified companies, because they are having multiple product lines, multiple industries. So even if one industry goes down, if the business or the time or the era of one industry goes down, still the diversified companies stock share, the share price doesn't move that much in ranges, and average it still says the same. Then let's talk about why people choose to invest in pure plays. First, there are few advantages also of pure plays. First of all, it is very easy to understand business module. The business module of pure play companies are very easy to understand. And second thing, pure plays companies are having like you can say very easy cash flow and revenue models. So you can easily predict the conditions, the stages of pure play companies. These companies can move very high in a short period of time if you are good in deducting and predicting the market or the market conditions. So these are few of the good examples, good advantages that why investors invest in pure play companies instead of having the negative and the disadvantages. So this was all about pure plays, the advantages, the conditions, and in which conditions, why people invest. These were all the discussions about the pure plays. Now let's come to the second term, which is floating stocks. What is floating stock? It's a term which is used by the investors, or you can say in the stock market or value investing. This term is introduced for the number of shares which are available of a company, number of shares which are available in the stock market for trading purpose, for public trading purpose, is known as floating stocks. What are low floating stock companies? Those companies which are having very less shares in the public market to trade, that is known as low floating shares. And the low floating shares are high volatile and having a high widespread and lesser volume. Just because, see, let's take an example that a company is having 100 million shares. So these 100 million shares, when they sign for an IPO, initial public offering, that what happens, it is divided into few parts. Let's imagine that 60 million stock, example, just an example, that if 60 million stocks are taken by the personally owned shares, that is those shares which are just holded by the company owners and the employees and the founders, the promoters, all those shares which are not available for trading, those are personally owned shares. Second part of the holdings are known as restricted shares. Restricted shares are those shares which are available in the lockup period. That is, whenever a IPO happens, there is a number of shares, a part of the shares are held in the lockup period, that is a temporary restrictions for trading. So a part of the complete number of shares which are registered in IPO, a part of it is taken by the solely owned company owners, promoters, and all the employees. Second part are restricted stocks, and third, the remaining part are publicly traded shares, and these are known as floating stocks. So if the value of this publicly traded stocks are very less, then those are known as low floating value stocks. Low floating stocks are never suggested by the investors, the long-term investors, and you can say mutual companies and insurance companies always invest in high floating stock companies, just because the low floating stock companies have higher widespread, just because of high volatility of the stocks. And if somebody buys the bulk of stocks in at one time, then the probability of just you can say the value of the share goes very high or very low at the same moment. So that is why, due to the high volatility, these stocks are not preferred by the mutual fund companies and the insurance companies, etc. So this was the complete explanation for the pure plays and floating stocks. I hope you got to learn the best from these two terms, and if you have any other doubts, you can watch this somewhere, this one stock value investing series, so you'll get the complete knowledge, more and more knowledge about a few better terms and everything about stock market. Thank you. Keep up the good values around you, keep all the people happy around you. Thank you.